Good morning, everybody, and I'd like to welcome everybody along, our clients in particular, to our budget briefing for 2024. Certainly the budget that was introduced yesterday was probably one of the more unique ones over the years that I've been involved in that I suppose that the level of manoeuvre that the government had and its ability and resources was significantly greater than heretofore, which I suppose brings along in its own right some interesting challenges in relation to it. And we get into that in a little bit more detail, but just a couple of points in terms of what we're going to do. I have a number of people who have joined us here this morning. We have our special guest, who's Alan Barrett from the ESRI. Alan's the CEO of the ESRI. He's been involved in the Fiscal Advisory Council, served on that over the years, and he's an adjunct professor in Trinity College. In addition to that, I have one of my partners here, Emer O'Riordan, who works in our privately owned business sector. She deals with a lot of privately owned businesses and has good insights into the key challenges that they face in the current environment, and she'll talk about some matters that the budget will impact from there. And as this is about tax at the end of the day, we have Cormac Kelleher. Cormac's our international tax partner and FDI person, and Cormac's going to give us an insight into the significant tax changes in the budgets that have been brought in, both at a corporate and personal level. So just a couple of practical items on our side of it. We do have a poll or survey that we would like everybody to participate in and give your feedback. It's quite useful to us. And secondly then, we would like you to pose any questions. We will answer questions towards the end. We'll have a period of time then. So if you have any questions that you'd like to ask of any of the panel, feel free to send them in to us here, and we'll try and deal with as many as possible. So just in the context of the budget for 2024, it is against the backdrop of, significant excess tax receipts that are there, in particular on the corporation tax side of it, and the windfall receipts that we've had for many years. And it's really, I suppose, the use of that, and I've looked at it in the context of what I call the four I's insofar as what's there, which is the issues and what has to be dealt with. So we have had inflation, which feeds into the cost of living, and that's been a big challenge over the past couple of months, certainly, and probably last year for people and for businesses. The second one is interest rates, where we've seen significant increase in interest rates over the past 12 months, and that has impacted heavily on people and their ability to actually, repay debt. Also, it's impacted on businesses insofar as borrowings and even getting transactions done and buying businesses. And the third one then is the infrastructure, including the housing side of it. That's been a big issue for the past couple of years, but it does appear on that front, certainly on the housing front, some progress has been made. The target for this year does appear that it will be met. I think the key issue there, maybe not necessarily the delivery side of it, but probably more so the affordable nature. So it's a combination of the two of those. And one of the pluses certainly coming from it is, while there is a downturn in maybe on the retail building and office building side of it, but that has freed up resources to concentrate on the residential side. So there is a plus insofar as what's actually happened there in terms of the country. And the fourth I relates to the investment funds. So we've seen the announcement, which is there are 2 investment funds proposed, which I think is quite positive insofar as balancing out, the current needs of people and what they need to get over this crisis. And that's certainly one of the particular, it's a more unusual feature where there are targeted measures that are short term. And when you see some of the things that have been brought in, even the interest relief and the landlord relief, they are short term, and that's on the back of, I think, the expectation that, there will be sizable house building that will fill that gap there. And then in terms of interest rates, I think the expectation that they'll come back down to a lower rate. And the tax reliefs that have been brought in, I suppose, are targeted to balance those particular aspects of it out. So it's quite interesting insofar as that targeted approach, which certainly one could beg the question as to whether you could apply it across a broader range of stuff when you're dealing with economies, and in particular when we're looking down ahead on this public sector pay increases coming general pay increases in private companies as well, is that can that be matched in some way or another as well. So there's many interesting aspects to what we're actually what we see in the budget of 2024. But the significant element of it is the excess windfall receipts on CT, which really has presented the ability to, I suppose, put out a lot of fires and give people, a lot of tax back through the proposed changes we see there, and also the supports to the welfare system, increases across education, welfare. So that vast array of supports, I think, is important in the context of the country here. And it's great that the country is in a position to be able to do that and afford it. The next part then, I'm going to hand over to my colleague Cormac Kelleher. Cormac's our tax partner here. So Cormac's going to give us a little bit of greater detail in terms of what's happened and some of the key issues from a tax perspective in Budget 2024. Cormac.
Thanks, Frank. Good morning, and thank you for dialing in. So just looking at some of the headlines in the paper this morning, we're seeing comments like budget for landlords, spend and save, typical worker to gain 800 a year. Like every single year in the budget, there are different views in terms of whether it's a good budget or bad budget, but the general consensus seems to be positive overall. The key winners out of this budget seem to be the middle income Ireland, as we're now referred to as. So overall, it seems quite positive. But if we just maybe look at some of the key issues or the key measures that are coming out in that. So in terms of the tax bands and credits, as per usual, there has been an increase in the standard rate tax band for single and married individuals. Normally that increase is about 1,000 of euro. This year it's gone up by 2,000. So the entry band to the higher rate of 40% has gone from 40,000 to 42,000 for a single individual. What is interesting in terms of what was not in the budget this year is that if you think back, way back when, 12 months ago, when the former Minister for Finance, Paschal Donohoe, gave his speech, in his speech at the time, he referred to the possibility of the introduction of a 30% tax rate. And he indicated that this is something that may be brought up now, 12 months later. The budget speech yesterday, though, however, was silent on this. So we still have our 20% and 40% rates with no reference to any possible change from that perspective. What again was well flagged was the change in the USC rates. Now, there were two changes made yesterday in terms of the USC rates. First was connected with the fact that the minimum wage is going to increase. So the lower rate or the entry threshold into the USC rates has been increased as well. That's basically to keep those on the minimum wage outside the scope of USC. The second change, which we all read about in Sunday's newspapers, was they changed the 4.5% threshold rate. That is going down to 4%. So this is again from the 1st of January 2024. What slipped under the radar to a certain extent, and if you only listen to the Minister for Finance's speech, was the announcement of upcoming changes to PRSI or social insurance. This appeared briefly in the Minister for Public Expenditure speech. In his speech, he indicated that there'll be a 0.1% increase, which he indicated is nominal, which we would agree, which is nominal. But, however, he also indicated that this is the first stage of a wider reform or change that needs to be undertaken with PRSI. The speech, however, didn't give a huge amount of detail, in the sense that we're not 100% sure, does this apply to employees only? Is it employees of all classes? And does it apply to employer contributions as well? The guess is, at the moment, that it's going to apply to everything. But we'll await for further detail when the welfare bill comes out. The other changes that we saw in terms of the bands and the credits was with the usuals, like the personal, the employee, and the earned income credit. They all increased by 100. Doesn't sound like a huge amount, but again, if you think of last year, those went up by 75 last year. So it's an improved increase on last year. The big change in terms of your credit was the incapacitated child tax credit. That increased by €200, and rightly so. The last time that was changed was 5 years ago. So 200 sounds good, but like as I said, it's been 5 years since it's been looked at. In terms of accommodation, this was obviously going to be a key issue in terms of the budget. It's now up there with healthcare in terms of one of the key issues that the government needs to look at every single year when it comes to its budget. In terms of the accommodation, we looked at the introduction of a rent tax credit last year that was brought in at €500. That has now been increased to 750. In positive news, in terms of a legislative change, there has been an extension of this. And by extension, what I mean is that when the legislation was introduced last year, it basically provided that parents who were paying for accommodation or digs for their college-going students, college-going children, they were not in a position to claim the rent credit on that expenditure. That has been changed, or that will be changed, in the finance bill, which will be announced next week. It is going to have retrospective effect back to 2022. So the good news is, if you paid for the kids, that's something you can look at going backwards, and there's a few bob extra of a credit there you can get. In terms of landlords, like I said, one of the headlines is it's a budget for landlords. In terms of that, what they're introducing is a credit, and it'll be a graduated credit going from approximately €600 in 2024 up to €1,000 in 2027. There is a clawback though, that you need to, if you put a property into this regime and you're claiming the credit in respect of it, then you need to hold on and let that property for the next 4 years. If you dispose of the property or cease to use the property for rental purposes during that 4-year period, there will be a clawback of this rental credit that you have claimed. Already again in the media, there's questioning of whether it's sufficient, this credit. Is €600 really sufficient to keep landlords within the market? We'll wait and see. In terms of the vacant home tax, this was introduced last year. This is also going to be increased already. It's going from 3 times the local property tax to 5 times the local property tax. This will apply for the next assessable period, which commences on the 1st of November 2023. In terms of energy credits, instead of our €200 that we're getting last year, we're getting something else again this year. We're going to get 3 credits of 150 each. That'll be spread out between now and April 2024. So again, that's quite positive. That is not factored into the headlines that I mentioned earlier on in terms of €800 being the beneficiary. So this is 800 plus your energy credits that we're looking at. So quite beneficial from that perspective. There's continued work being undertaken in terms of retrofitting homes and making them more sustainable from an energy perspective. A number of years ago, we introduced work with the SEAI in terms of grants and so forth there. There's a new low interest rate loan facility to be introduced, which will run in tandem or in conjunction with the SEAI grants. We await further details on that, and it'll be interesting to see how that operates. Petrol and diesel, what happens at the pumps? That was supposed to increase. This was a reversal of excise duties that were supposed to increase later this month. This was kind of one of the measures that was introduced last year. It has been decided not to proceed with that. So hopefully our fuel prices will stay down for another while. In terms of your gas and your electricity, normally that is vatable at 13.5%. However, a measure was introduced last year to provide that they would be vatable at a 9% rate. That 9% rate is going to be extended for a further 12 months. What does that actually mean? It's estimated that the average bill holder between their gas and their electricity is going to save approximately €150 to €160 over the course of the next 12 months because of this lower VAT rate. Again, to be welcomed. Looking at investments, and this is kind of a suite of measures that was introduced to help the SME sector. We have an employment and investment incentive, or if you can remember back far enough, it's a BEES. In terms of the employment investment incentive, it's been around for a number of years, but if you look at all the pre-budget submissions over the years, there's regularly lobbying being made to have it reviewed and enhanced. That has been listened to this year. 2 changes that are going to be made is one is the investment period. Under the current rules, some of those investment periods are up to 7 years. This is all going to be changed, whereby from 1 January 2024, the investment period is going to be standardised at 4 years. The second change that's going to be made is the level of the investment an individual can make. Currently, that is capped at $250,000 per investment an individual can make. that is going to be increased to 500,000 from 1 January 2024. Again, positive in terms of access to an alternative source of funds for the SMEs sector. Capital gains tax retirement relief. This again is a relief that has been on the books for many, many, many years. I remember having to study it once upon a time when I was in college. That's gone back a few years. So in terms of that relief, this is being given, or you've been given a window to look at this. Measures have been announced, but they will not be coming into play until the 1st of January 2025. The reason being, under the current rules, whereby a parent transfers a family business, that could be a farm, it could be a shop, it could be a pub, to their child, and they're under 65 years of age, there's no value placed on that business in terms of retirement relief. However, according to the speech yesterday, and like I said, we await further detail in the bill to be published next week, it would appear that a limit of 10 million will be placed on the family business. Now, for many family businesses, they would love if their business was over 10 million. But for those businesses that are fortunate enough, this is something that will need to be looked at in 2024. Otherwise, there could be a significant tax bill in 25 and subsequent years when that gets transferred. The film tax credit, that is also being reviewed as well, in terms of that's going to be increased in terms of the level of funding that can be raised there. Looking at the business side of things, the Minister referred to the changes from a business perspective as being a once-in-a-generation reform, and he's not wrong. What we're going to see is that there's going to be significant changes to corporation tax over the next number of years. This is all tying in with the global tax reform packages that are currently working through. In terms of the corporation tax rate, we're still going to have the famous 12.5% corporation tax rate, but we're going to have a second rate of 15%. This is likely to come into place from the 1st of January 2024. We wait further details on this when the finance bill gets published next week. It's going to be very, very complicated, but it's only going to apply to groups where the turnover is 750 million or more on a global basis. So it's only the very, very big companies. For the rest of the companies, the SME sector, you're still with your 12.5% rate, but there's no change from there. Other changes that are coming down the track from a global perspective are our taxation of foreign source dividends. We have a regime at the moment. It is a credit mechanism that we operate. It is quite difficult. It is quite difficult to explain. It is quite difficult to navigate. It is quite difficult to apply. What we're going to see, again, in the draft legislation to be announced next week, is what's called an exemption method. So this will simplify things significantly. It'll ease administrative burden. It is highly welcomed. Interest deductibility. Ireland has incredibly complicated rules in terms of deductibility of interest, particularly for wider global groups. So there is going to be change made there. We don't know what it is at the moment, but we're going to have a consultation process. So that's again something that we're going to see in 2024 on this consultation process. So if you're one of the larger groups that are impacted, watch out for this because it will be coming down the track and impact you. Another positive change that was introduced, and that's going to affect large and small companies in equal measure, is the research and development tax credit. It's been on the books for many, many years. And I suppose, again, tying in with the global tax reform, what we're going to see is that the tax credit is going from 25% to 30%. So for the very, very large companies that are going to be impacted by the 15%, there's going to be no real net advantage to them. They're going to be basically back to where they started if they had a 25% rate. But who the real winners are here is going to be the smaller companies. So they're going to get 30% of a credit as opposed to 25% credit. This will apply to expenditure incurred on or after 1 January 2024. So very, very positive. The second change that's been made there is for smaller companies that are going into the R&D regime for the first time. So under the current rules, the first 25,000 is accelerated for repayment. That's going to be increased to 50,000. So it basically means more money faster for the smaller businesses. In terms of capital taxes, the entrepreneur relief, there is going to be a review undertaken. Again, welcomed. Entrepreneur relief is basically a reduced rate of capital gains tax down to 10%, where certain conditions are met. Again, people have been lobbying over the years to enhance and improve this, so it's positive that a review will be undertaken in 2024. A new measure which was introduced, again in the capital taxes space, and is being marketed or positioned as a source of alternative finance, is the introduction of a specific capital gains tax regime for what are called angel investors. So these are investors who make investments in smaller companies. Typically those investments will be liable to capital gains tax at 33%. What is now being proposed under this new measure is that the investor, instead of paying tax at 33%, they will be paying capital gains tax at a rate of 16% or possibly 18%. That reduced rate would apply, it would be a lifetime limit of 3 million, and it would apply to basically double the gain on their original investment. The level of the investment would need to be somewhere between 5% and 49% of new shares in the investment company. Again, initial thoughts are, is it good enough? Because if we think about what an angel investor is an investor that tends to diversify their risk across multiple companies. It's possible that the level of their investment is less than 5%. And if that's the case, they're still back in the mainstream rate of 33%. So it'll be interesting to see if the final piece of legislation stays with the 5% or if it's tweaked. Looking at agriculture, there was a number of measures introduced yesterday's budget. However, the majority of these measures are more extension of existing reliefs that are there. Again, they are welcomed. So one of the bigger ones was stamp duty and the extension of consanguinity relief. So what consanguinity relief is basically that if you transfer a farm from one generation to the next, normally the stamp duty rate is 7.5%. However, where consanguinity relief kicks in, it's 1%. So again, very, very positive in terms of savings and encouraging transfer to younger generations. In terms of indirect taxes or VAT, one of the changes that's been made is the registration thresholds. The registration thresholds for businesses that need to register for VAT have been increased for services and for goods. The increases are 2,500 and 5,000. Again, very, very modest. But this needs to be looked at in the context that the last time this change happened was 2008. So any change is welcome. It'll keep smaller businesses that are on the cusp of these registration thresholds out of registering, keeping them and reducing their compliance burden. Other changes that we're going to see is the reporting system. Now, again, we kind of expected this, but we didn't necessarily expect it to be announced next week, or yesterday even. The reason we kind of expected it is because there is an EU project ongoing at the moment, whereby the reporting of VAT is being looked at. The EU are working towards a date of 2028, so 5 years out in terms of this. What this project would look at is that there'd be standardization and digitalization of the capturing of invoices in terms from a payable and a receivable perspective. And this would be across the EU. This is going to require standardization of your systems. Your systems will need to be set up in such a way that it'll be captured. What we'll also see, and what we're likely to see rather, is it'll be similar to PAYE in terms of the PAYE modernisation, where all details are reported on a real-time basis to revenue. So instead of giving details to revenue on a bi-monthly basis on your VAT tree, you're basically giving that information every single time you receive an invoice and every single time you make a payment. A consultation process is to be announced by Revenue on this in the next number of weeks, but it's not something that's going to be implemented in the very, very short term. But again, like I said, we need to be conscious of the wider EU project that is happening here. Other changes that are after coming in is things like ebooks. So ebooks at the moment are liable to VAT at a rate of 9%. However, the traditional hard copy version of that is liable to VAT at 0%. So this is going to be harmonised with effect from the 1st of January 2024, whereby ebooks and hard copy books will be both liable to VAT at 0% rate. Just two other measures very briefly. One is to do with e-cigarettes or vapes. We expected something to be announced in the budget on this. However, what has been indicated is that domestic measures will be introduced in next year's budget. And in terms of charity, there's an existing regime for charities who are not VAT registered and do not have a basis to recover VAT. There is a scheme at the moment. The value of that scheme is as a pot of 5 million. That pot is to be increased to 10 million. So overall, a number of measures that are very, very beneficial to individuals from their own personal perspective, equally some measures that will be beneficial for businesses from an SME perspective. But it'll be interesting to see how they work out. There's lots more information to be announced next week in the Finance Bill. So we'll be publishing some information on that for you. And equally at the moment, there's other stuff up on our website. So back to you, Frank.
Great, thanks Cormac. So next up we have Alan from the ESRI, so he can give us a perspective upon what's going to happen from an economic side of it and how the country is currently doing. So away you go, Alan.
Great, thanks so much, Frank, and thanks to Mazars for the invitation to come along and talk to you today. So my talk over about the next 10 or 15 minutes or so is sort of a bit broader. I want to talk about the economy more generally, but of course it's very tied into the budget. I mean, at one level, and Frank has mentioned this already, the resources that we have available have a lot to do with the structure of the economy and the fact that there are so many foreign multinationals here. So I want to talk a little bit about what's sort of evolving there. And of course, budgets can have an impact on the economy as well. Okay, so just a sort of a quick point on this. Many years ago, the Finance Minister, Charlie McCreevy, was criticised quite robustly when he used the phrase, when I have the money, I'll spend it. Okay, and it seemed to be that collectively we as a nation started to understand that fiscal policy and the fiscal stance matters a lot, and that really what we should be aiming for is counter-cyclical budgetary policy. Okay, now that sounds like a bit of a mouthful, but I think most people on the line are going to understand what that means. Generally, you want fiscal policy when the economy is in a downturn. You want an expansionary fiscal policy, so the government in a sense is sort of providing buffers, and then when the economy is doing well, you want the government to do the exact opposite. Okay, you want the government to have a sort of a prudent and a cautious fiscal policy, whereby the resources are then going to be available for later on. So this message, I think, has got a little bit lost, all right? And one of the reasons for that is a lot of people this time around in this budget interpreted caution as not spending all the windfall corporate tax gains. Okay, that was the definition of caution. But of course, the notion of counter-cyclical fiscal policy is a bit deeper than that. But let's tease it out a little bit anyway, and we'll see where we end up. Okay, so like I said, I want to give a sort of an oversight, an overview of happenings in the economy. And I'm drawing on the work of some colleagues, which was published about a week ago in our quarterly economic commentary. So you can see on the slide there, we've got forecasts of GDP and modified domestic demand. And we all know for 2002, we had this massive post-COVID bounce back and the economy was doing extremely well. Okay, as we've come into 2023 and as the year has progressed though, a number of concerns have started to emerge. Okay, I'll talk a little bit more deeply about this as we go along. But it is important to note that the multinational activity, okay, which was the source of so much of the buoyancy of the economy, is contracting somewhat. Okay, and that's why we have on the screen there a GDP forecast for 2023 of minus 1.6%. So it seems quite extraordinary, actually, in spite of all the positivity, that on that narrow measure of the Irish economy, that it looks like we'll be technically in recession. I think everybody on the call again knows that we don't have to get too hung up about the GDP numbers, but look even at the modified domestic demand. Okay, my colleagues are using the word normalization. Okay, so normal countries have growth rates of between sort of 1% and 3% per annum. So the sort of figures we were seeing in Ireland for quite a while were not normal, but it seems we're sort of gliding towards normality to a great extent. And then you can see for 2024, again, growth rates that are more in the ballpark of normality. So I'll say a little bit more about what's sort of driving these figures, but just also say I think I'll say a little bit more about inflation later on too. So I'll flag it there, but I'll talk about it when the relevant slide comes up. Okay, so again, people on the call who remember doing their economics in college, the old identity of gross domestic product being made of C plus I plus G plus exports minus imports. If you were all in the room with me now, I'd be asking that question and would have given bonus points for those who had known the answer. So just to interpret the figure here, the solid blue lines are blue bars. That's growth between 21 and 22, okay? And then you can see the various components. So you can see all those chunky blue bars meant that consumption was growing very robustly, government spending increased, investment, exports and imports, okay? Everything you want. Okay, the green dots are what's been happening so far in 2023, okay? And the important thing here is the two green dots that are lying below the line. All right, so investment for this year is running below, is actually in negative territory, as are exports. Okay, the investment figure isn't entirely surprising. There are some base effects to do with the post-COVID bounce back. But nevertheless, those negatives are very, very important. And even if you look over at the consumption section there, you see the green dot way lower. Okay, so the trajectory we seem to be in for 2023 is just a good deal lower than where we previously were. Okay, so let's talk a little bit more then about the consumption figure that I put in there. Okay, so again, back to 2022, we had that massive surge. 2023, we expect consumption to grow by about 3%, so a long way down. Okay, but what's going on here? Okay, so there's a number of points. I won't necessarily go into all of them. Obviously, the inflationary pressures are now having an impact on households. Okay, so they're facing their budgets are squeezed, so that's sort of depressing consumption. But I'm going to actually go straight to the next slide because there's an interesting point here. Okay, so see the picture on the left-hand side there where we've got a blue bar and we've got a green bar. All right, so the blue line, that was the early estimate of the savings ratio. Okay, so that's the Central Statistics Office come up with a sort of figure, basically talking about across the nation what proportion of income is being saved. Okay, and you can see the blue line, okay, from Q3 2021, the line seems to be going up. It seems that savings were quite elevated. All right, and there was a lot of talk around this time about this sort of savings glut, and would this savings glut then sort of spill out into Ireland and have that really sort of strong effect on economic growth. But it turns out actually that the data often does get revised. This isn't the CSO do this regularly, as do all international statistical agencies, so it's not a criticism. But you can see actually that the savings rate had been declining in a way that we hadn't expected. So when we were previously doing forecasts of consumption, we were factoring in this high levels of savings, which we thought were going to materialize, okay, spill into consumption. But as you can see, the savings rate has normalized to a much greater degree. And if anything, the savings rate is going up ever so slightly again, which is probably a thing about people reacting to uncertainties such as interest rates, inflation, and some of those other factors. Okay, the picture on the right-hand side, okay, there's one point to be made here. Okay, very, very often, Ireland's economic statistics just look different. Okay, sometimes it's very different on the upside, and from time to time it's very different on the downside. But if you look at the green line in the figure there, you can see at various points consumption was growing in Ireland and much more strongly than other European countries. But if you come to the end of the picture there, you see for Q2 2023, the most recent data, you see that Ireland has essentially now rejoined the pack. All right, and that's kind of when I would use the phrase earlier on about normalization. Okay, that return to more normal growth rates, I think, is now manifesting itself. Okay, I talked earlier on about exports declining, and let's go a little bit more deeply into this. Okay, and I mean, essentially at the moment, you cannot talk about the Irish economy without talking about ICT and pharma in particular. Okay, these are just the sort of, they're dominant sectors in terms of explaining the recent growth trajectory, and they're dominant sectors in terms of explaining an awful lot of the corporation tax. Okay, so very, very important that we understand what's going on here. Okay, and when I talked about exports now beginning to decline, most of that effect is actually to do with pharma. Okay, ICT is actually holding up much better than you might have realized, because again, if you think about all the headlines around job losses in some of the major ICT firms, that doesn't seem to be actually sort of translating into output in that sector. So again, I can give you another picture of this. This is once again where we've got blue bars, which said, this is what happened in the earlier part of the year. The green dot is the most recent data, and you can see goods exports are now estimated to be falling by about 9.5%. The services, okay, and that's primarily ICT, you can still see is in positive territory. So we have this sort of a divergence across these two major sectors. And again, back to the picture then on the right-hand side, this is another one where I want to sort of compare Ireland to a lot of European countries. Okay, and these are, again, export end, the growth rates in exports. You can see there, a substantial part of the picture, Ireland is lying way above the European competitors, but now we seem to have converged to where the rest of them were. Okay, I don't need to go this in great detail because it's essentially saying the same thing. It's looking at services growing on the one hand and looking at computer services, and then on the other side we're seeing those lines below the bar. It's still a bit of a shock to the system. We're not used to seeing lines going into negative territory in Ireland. So, obviously there's a question then about sort of, how long is this going to last? But important to be cognizant of what's happening. Okay, I mentioned earlier on, investment is another component of the story where we seem to be, the GDP growths are being drawn down. Not entirely surprising. Okay, colleagues at the Institute have done work. I mean, by definition, the reason interest rates are being increased are to reduce demand in the economy. Some of that comes through the consumption channel, but a lot of it comes through the investment channel as well. Okay, so it would have been absolutely staggering if we had seen the increases in interest rates of the level that we had and that we hadn't seen corresponding falls in investment, but that is now clearly happening and is showing up in the data. Okay, I want to talk a little bit about the labour market as well. Again, not a great detail, but there's particular points I want to make. I mean, I kicked off the talk by talking about this notion of counter-cyclical fiscal policy. And so the question is, should the budget be expansionary or contractionary? Okay, and everything I've sort of said so far has been like sort of talking about the slowing in the economy, which might lead you to think, okay, well, maybe actually this is an opportunity or the time to start stimulating. All right, but with reference to the labour market, I think the answer to that particular question is no, it's too early. All right, so let's look at the picture rather than sort of going through the words. So if you see the green line there, okay, that's the unemployment rate. And what you can see is Ireland's unemployment rate is now really at a remarkably low level. Okay, 5% is almost, and I think it's even lower than that, depending on the definition. Okay, but we're at an irreducible minimum, actually. Now, if you look at the blue line, that's the vacancy, or sorry, the number of vacant jobs. Okay, so you can see there the number of vacancies peaked. It is trailing off a little bit. Okay, but there's not an awful lot of evidence to suggest that the labour market is, in a sense, beginning to exhibit any slack, whereby those notions of sort of compensatory fiscal stimuluses are required. Okay, I also said I'd say a little bit about inflation. So here's the picture of inflation. Apologies for looking at my watch. I'm just eager that we get to some questions and answers. Okay, certainly you can see clearly from the picture there on the right-hand side where we've got euro area, HICP, Ireland as well, and you can see that inflation has certainly come down from the heights of about a year ago. But the problem, of course, is if you look at the right-hand part of the line isn't just coming down continuously. All right, and we've got this difficulty now, possibly at least, whereby the first sort of surge in inflation was related to energy. Then food prices started being part of the issue. And then the question now is, are we going to start seeing, or have we seen already, impacts on wages, whereby inflation is actually modestly embedded in the economy? Okay, it's too early to say really what the answer to that is. My colleagues, given it their best shot, have sort of estimated that inflation will indeed come down next year. And you can see, for example, hiccup inflation would be about 2.8%. We can hope that that's going to be the case, but I think this is something to be kept under review. Okay, this is a slightly different slide, okay, but let me talk about it very briefly because I think it's really important actually in two contexts. Okay, so I'll explain what's going on here and then we'll get into the details. So look at the right-hand side and look at the top panel. Okay, and what this is, Ireland's ranking and current and capital expenditure. So what my colleagues have essentially done here is that they've looked at government spending across current and capital per head. Okay, and the green line is capital spending and the blue line is current. All right, and here's the important point. At various stages of various times, Ireland has ranked very, very highly on capital expenditure, but then we had this kind of significant dip, and then we're on the way up again. Okay, and some of that line explains some of the bottlenecks that we actually have in the economy because we haven't been able to maintain sort of consistent levels of infrastructural investment. What is really, really sort of pleasing about yesterday's announcement was this notion of trying to set up funds that will sort of smooth capital investment over time. So I think that's really, really positive. The blue line, I'm just going to put it up there and others can talk about it if they want, but this question always comes up. Are we a high tax country or a low tax country or a medium tax country? All right, and everybody tends to answer that question with reference to their personal paycheck and income tax. But of course, we know in Ireland, for example, national insurance contributions are lower, wealth taxes are lower. So if you want to look at the totality of government in the economy, one way is to look at the totality of spending or the totality of tax. My colleagues have done this here. You see the blue line there. Where does Ireland rank across the European Union in terms of current expenditure? And you can kind of see we're actually a mid-ranking country. All right, so it's not entirely clear where you hear all the time about squeezed middles and, you know, the high tax burden and everything like that. The data on Ireland, and if you look at it comparatively, is a little different. Okay, I know I've rattled through a whole load of points and I'm eager to get the questions and answers. But rather than talking in detail, let me just sort of take a minute to give a sort of two overview points, okay, on the budget. So the first, I began with the question about counter-cyclical fiscal policy. I think it is, you know, it is probably the case that the budget is overly stimulatory relative to where it should be. My former colleagues in the Irish Fiscal Advisory Council have made that point, and I think others will make that point as well. But I'm not so naive as to stand up here and say that economic security is always going to drive budgetary decisions. There is a political reality. And let me put it like this. Sometimes when I was on the Fiscal Council, people would say, are you being ignored? I think the degree of the sort of counter-cyclicality in the wrong way might have been an awful lot higher if you hadn't had people like the Fiscal Council and others making points. Last point I'll make then, the value of the funds that have been set up. This is actually quite far-sighted, and there was a certain amount of discussion yesterday that this was the first time the Fianna Fáil minister was giving the budget in many, many years. I was talking about Charlie McCreevy earlier on. This might be unusual that we're going to get two quotes or two references to Charlie McCreevy in one budget. But of course, he set up the National Pension Reserve Fund. Which at the time was a very visionary thing to do. The receipts from Aircon went into it. There was the commitment to pay money in over time, whereby, and that was specifically then to look at pensions. Okay, history kind of got in the way, and that particular initiative was you know, didn't last. The money was required during the great financial recession. But nevertheless, that notion of putting money aside and building up funds in that sort of long-term perspective, I think is something that is really to be valued. The increase in PRSI, while modest, even that notion of sort of saying, yes, we haven't increased the pension age, but we were aware that there's a long-term problem. I think that, again, deserves to be applauded. So I'll leave it there, and we look forward to the questions.
Great. Thank you, Alan. That's excellent insofar as I think it gives a great sort of perspective upon the economy in total. And I think for people and businesses, I think also it lets them reflect upon sort of the years out ahead and what that's useful from, because sometimes, you know, we can get stuck too much into our own areas and we probably miss out on a little bit on the bigger picture. So much appreciated and thank you. Just to go to our poll, the survey that we did for this particular presentation, we had three questions that we raised in relation to it. The first one was, bearing in mind the level of inflation and general cost increases, does Budget 2024 fairly address these issues? The yes on that was 61% and the no was 39%. Probably a little bit lower in terms of the yes than I would have thought, but that's democracy. The question number two was, are the proposed business supports in Budget 24 sufficient in the current environment to insulate businesses and their employees? The answer to that, yes, was 44% and no 57%, which I can probably get a feeling for as well, in that it certainly, there could be probably a little bit more done probably on the business support side of it, and people are looking at it. There's a lot of stuff done at probably the individual level, but not as much, it would appear, for businesses. So that's something to take on board. And then the third question was, is the government's approach to the use of windfall corporation tax receipts reasonable? And 71% said yes, and 29% said no. So I think that probably does reflect probably fairly well upon what has happened in the particular budget. So it's just interesting to get people's feedback, and thank you to everybody who participated in that. So we will move next on to the question part. We got a number of questions raised with us here just in the context of the budget and the overall economy. Emer is here, Emer Reardon, one of my fellow partners here. She's on the POB business side here. And she deals with lots of smaller type businesses, comes across all sorts of issues and challenges and helps them and supports them. So Emer, there's a couple of questions we have in here on that. What do you feel the main current challenges are for the POB businesses, bearing in mind sort of all of the inflation is there, employees, you're looking for more employees, tough out in the marketplace there. Yeah. What do you think the key challenges are?
Well, I suppose in Alan's presentation, he obviously covered inflation, which is the number one. And businesses have come off the back of a lot of volatility in lots of expense areas on the direct cost side, such as, energy and freight, and then lots of supply chain challenges, and certainly, and just general price increases. So inflation has been the number one. But number two, as you said, that mismatch between the demand for labour and then the actual supply of labour. Recruitment and retention is probably the biggest challenge that we see. There's lots of cost of living and housing kind of macro issues, and they translate into the value of wages and salaries that employees are getting into their pocket. So that translates then from a business perspective into wage inflation. So I think that's been one of, and just resourcing and being competitive, I suppose, as a country and then as businesses individually. And then, of course, also that investment. There's been a cooling off of investment availability. So the cost and availability of funding is a challenge for particular sectors, especially those looking at earlier stage investment. With geopolitical uncertainty, there certainly has been more uncertainty and more difficulty just in raising finance. And with increased interest rates, just the cost of that debt has been, on the debt side, is obviously just more expensive for businesses to shoulder.
Great, thanks, Emer. And Alan, just in a couple of questions, and I've banded one or two together, maybe if you don't mind. What do you see for the Irish economy when you look out sort of over the next 3 years, insofar as how it will be? Or we've seen in certain other countries, the UK, Germany, and places like that, where there have been, recessions, as we want to call it. What do you think Ireland will sort of look like over the next couple of years?
Neil's a very difficult question to answer, but I think the best thing I can probably do is just sort of talk about where are the risks and the vulnerabilities. And I guess that issue of corporation tax reform is something that has been hanging there now for quite a while. But I think we collectively don't as yet have an understanding of the extent to which the reforms are really going to bite. Okay, so I talked in my presentation about the importance of foreign direct investment in Ireland and the major companies that are here. Work done by my former colleague John Fitzgerald, which we published in the ESRI recently, really showed the importance of these companies too, not just in terms of corporation tax, but their contribution in terms of the wage bill. Okay, so something like 10% of the workforce in Ireland are employed by foreign companies, but the wage bill is probably closer to 20%. Okay, because these are much higher sort of value jobs, if I can put it like that. So we have a heavy reliance on this group, and of course within that then we have a very high degree of concentration. I talked about it earlier on. Pharma makes up something like 60% of exports on the goods side. ICT makes up a similar proportion on the services side. So anybody with any sort of sense of concentration risk mitigation, all those sort of that your economy is so concentrated in these areas at a time that your principal policy tool is perhaps going to be watered down. I think it's a risk. That's the only way I can put it. So I mean the mitigation efforts then are certainly will include this notion of partly making sure the tax changes maybe are the impact is as limited as possible, or also that there are other dimensions to the IRA story, such as the educational levels, access to labour from to the EU, all those sort of issues. So I think for people in my position, it's a slightly worrying time. And we'll just sort of see how it works out. So I think that's the best I can do.
Yes, we don't like to see worrying economists.
No, indeed not.
No, thank you, Alan. That's quite useful to give us some insights into it. Cormac, just on the Minister, one of the questions in here is to do with the tax simplification. And I think you mentioned it in the course of your particular presentation. But certainly for a period of time, I think a lot of people who work in the tax side of things would feel that it's too burdensome. It's sometimes, maybe too difficult in the overall sense. Stuff isn't consolidated enough. Do you think that this time that Minister McGrath is committed to trying to simplify that, or do we see benefits? Because every time I look at tax returns and clients talk to us about it, it really is that the compliance burden is very high. So do we think there will be real change there?
Yes and no, I think is the answer. I think when you look at, say, maybe simplification, I think he mentioned simplification in the context of individuals, maybe. And I think we mentioned that, I think was it 180 million or something like that for 2022 of tax refunds that people hadn't claimed, basically. So I think there was an element of that, making it an awareness of the credits and the benefits and so forth people get. And maybe I think he said he's going to announce kind of an education or kind of a communication program there as well. But in terms of, I suppose, simplification of tax returns, you would like to see it. But the reason I'm saying yes and no is kind of going back to my slides about the global minimum tax. So when this 15% rate comes in, and I know it's not every single company, but the companies that are going to be affected by it, in terms of the information that they're going to have to give, there's somewhere like 230 pieces of information that those impacted companies will have to return on their tax return, right? So the tax returns, say the corporation tax returns, are already long enough, but if there's all this new information that's going to have to come in, they're going to get bulkier. So there's definitely a need for simplification, because even in our job, we'll say as tax practitioners, there's probably pieces of legislation that's, it's redundant, and maybe there's a bit of a cleanup on some of those pieces of legislation, and then that could kind of ease some of the simplification. But it's not going to be simplification to the nth degree, unfortunately.
Very good. Thanks, Cormac. And just back to a question in here. In the context of the projected inflation rate in 2024, which I think the government had down at 2.9%, and bearing in mind the once-off benefits that have been given out to try and address that, do you think that that's a reasonable projection? It looks like a significant decrease from last year, and hard to see what will come through. Or are we looking at this, maybe for a little bit longer?
No, I mean, I think the projections are reasonable, and there's also a sort of sense of consensus around it. Okay, now there's always a sense, obviously, forecasters look at what one another are saying, so they're not entirely independent observations or anything like that. But I mean, I guess the people with the sort of strongest oversight of this would be the ECB. And to the extent that the language around interest rate increases has been softening, I mean, I think they're sort of shifting now into the zone of sort of saying interest rates might have to stay higher for longer, but I think the expectation is that rates will come down over time. The method the government has used, actually, though, to deal with this, as in the one-off payments, has been very, very interesting. And colleagues of mine did make the point last year when they were doing analysis of the budget that there was this risk, okay, that you call something a one-off payment, but if the problem was still the same the next year, then you had to do the one-off payment again. If the inflation forecasts, do turn out to be wrong, well, then we're going to be in this situation of asking, well, is there going to be another one-off payment, which will be the third in a row? And we know, that sort of expectations can build up over time. So where there's all this, sense that this is not adding to the permanent burden of, government expenditure or anything like that. If things get embedded, and I think the Christmas bonus is an example of that. I mean, the Christmas bonus is theoretically decided every year, but yet it happens every year. So I think that I wouldn't necessarily describe it as a worry. But I think if inflation persists and the one-offs have to persist, we are going to end up in this sort of strange situation, I think, then of how do you actually characterise those payments.
So permanent one-offs.
You're almost getting it was a bit like remember the temporary tax reliefs that had I think it was a fairly elastic definition of temporary. Would have been the case. But it is interesting that once something gets into the system and gets expected, it is next to impossible to remove it.
It's a bit like USC.
Yeah,
USC was
USC,
a temporary tax measure.
Yeah. Well, that
Temporary
was
in whatever 2007 was it?
We're still there.
yeah, exactly.
And Emer, just in the context of the business supports that were actually announced in the budget, with your question here is, do we think that they're really going to help businesses? It looks like there's a fund there, approximately 250 million. And I think it's potentially there's 130,000 businesses from what I see who could apply, which if you do the maths on it, it's not a huge sum. So what's your general feeling?
Well, I think that particular increased cost of business scheme seems to be aimed at a large volume of smaller businesses. So it has limited benefit really to more medium size and those growing businesses. In terms of other measures, there are certain sectors I think will be very hard hit with the increase in the minimum wage up to $12.70. That's a very significant increase. Sectors such as hospitality and retail, they will certainly feel that. In addition to, I suppose, this pension auto-enrolment coming down the line, and also the increase in PRSI, which we expect will actually impact on employers' PRSI and looks set to even continue by the language that was being used yesterday. So other than on a wages and salary side, other than the personal tax benefits that people who are receiving wages and salaries, that they will feel more benefit and that more value for their wages and salaries, which will have a benefit hopefully for businesses on that translation into wage inflation sort of pressure. But other than that, on that side, on support for businesses in those type of sectors, I don't see that much direct support being given. There's a bit better news, I suppose, on the investment side, just with some of the reforms on the angel investment and EIIS, etc. But that some of those, and the R&D tax credit, I think, will be the most widely felt benefit. But that again has a sectoral preference to, I suppose, growing and scaling technology businesses, which is great for them. But I think there are large swathes of sectors and sizes of businesses in sectors which won't feel that much support from the measures that were taken yesterday at all.
Yeah, and I think certainly the point you make on the minimum wage certainly is relevant insofar as while it's certainly needed by the individuals, you know, and I think it's an important sort of support in the economy for employees. Equally, I suppose on the other side of it, it has to be funded, and it's a significant initial element. And I suppose arguably one could look at whether there should have been, some degree of support, at least maybe in the first period of time. I think it's 12% of an increase. So that's something
yeah, which is very significant for certain sectors.
Yeah. Okay. So yeah, that's in the main a lot of the questions. I'm conscious of the time side of it. There's just a couple of points I'd like to make on the general tax side of it before we go. We always try and give you sort of one or two little tips before the year is out, and just two probably that I'd like to make. First is in terms of pensions, probably the best ways for people to secure income into the future is to contribute into pension funds, in particular with auto-enrolment coming up in 2024. There'll be an opportunity there to contribute. Individuals contribute, companies contribute, and the government is going to contribute. So there is no better way to, I think, build up a fund of money in relation to it. And in fact, I was talking to somebody about 2 weeks ago who had recently retired from employment, and they're getting the social welfare pension, which is €265, or was €265, excuse me, per week. But they also had a pension fund that they built up over the years of, I think, about 200,000. And comparing that person with, say, on the 265 versus the person who was in the 265 plus their pension fund, they estimated that instead of having €265 per week, they're probably going to have about 465, which is actually quite important. And to build a fund of 200,000, when you look at, say, contributions from yourself, from your employer, and hopefully the government, it's certainly something that we would encourage everybody to look very closely at, and to put some funding in there, because in particular, when you look at the cost of living crisis, it is nice to have some supports that are available there, rather than necessarily being, stuck on the basic social welfare pension. So provide a little for the future, and maybe in terms of some of the tax reliefs that have come through, there will be something there. And the second one then is in relation to the benefits. As you're probably all aware, there is the €1,000 tax-free voucher and benefit. Just be careful. You can give 2 benefits in the year, but sometimes people misinterpret what benefits are. And a benefit can be something very, very small. Just beware of the Easter egg, as somebody says to me before, because it can give rise to problems. But it is a really good incentive, and a tax-free amount, in particular around this time of the year, of up to €1,000. There's a lot of purchasing power in it for people, and various ways in which you can spend it. And allied to that, I certainly would encourage everybody, if they are spending their vouchers, which hopefully they all are, is to buy Irish and spend locally, not on the internet. But Irish businesses do need support. They're the ones who are going to be paying the wages. They're the ones who are going to feed into the economy here. So I think it's important that we do that. So those are I suppose, our 2 points in relation to the general tax side of it. So that brings our presentation here to a close. I'd like to thank all of the people who have participated, in particular Alan, who's been our guest speaker for the day, who's given great insights into what's actually happening. Emer as well, thank you very much for participating too, and Cormac to give us some great insights. There is additional information on our website, www.mazars.ie. The government website has a lot of information, which is www.gov.ie, so there should be some more information there. So thank you all very much for attending this morning, and if there is any particular items in the budget that you need help on, just make contact with your usual Mazars contact. And good morning to everybody.